Hello, everybody. I'm Casey Lau from kclau.com. I'm excited to see you around. Welcome to this online training, which is an educational initiative brought to you by Bursa Malaysia Derivatives Berhad. Many people perceive that trading futures contracts are risky. It can be very risky. In fact, if you don't know what you're doing. For example, is it risky to drive a car? Yes, if my 11-year-old boy is driving my Mustang. But if Lewis Hamilton is taking it for a spin at like 200 kilometers per hour, I don't think it is as risky as my son driving it, don't you think? Right? So today we are going to provide you with the knowledge to properly plan your finances when coming to futures trading. So it's my honor to have Mr. Warren Mark, the founder and managing director of Wealth PLT. He has vast experience in trading, investing, risk management, and frequent training in stocks, structured products, money market, and fixed income securities, forex, swaps, forwards, futures, option, everything, and even like cryptocurrency. So Warren, as a CFP, Certified Financial Planner, today we are going to cover financial planning in futures. Welcome, Warren.
Thank you, Casey.
Awesome. So I think you already have your slides up. Nice.
Yeah.
Looking at it right now. Great.
All right. So just to repeat, this derivative webinar is an educational initiative brought to you by Bursa Malaysia. Okay, let's start. So I hope some of you have attended a webinar conducted by my friends Chung Ting Ting. She covered 3 topics in 2 languages, altogether 6 webinars. And also last 2 weeks, I covered 1 topic in 2 languages because with the background or with some basic understanding, you will follow this webinar more easily. But don't worry, in case you really do not follow any of those, and this is the first one, not to worry because eventually you will get all the previously recorded webinars from email sent by Casey Lau, including this and also the another 3 in the next few weeks. Yeah, so make sure you receive the email and then you can click the link in the email and then listen to all the previous one. So basically today we want to talk about this is a quick guide for financial planning in futures. And before that, disclaimer: this presentation is provided for academic discussion information purposes. So that's why anything I discuss here is not a buy call, sell call. Whatever investment decision you make, priorities, please consult your investment advisor. Okay, today we are going to discuss some of the risk management policy implemented by the clearinghouse. Not all, because some of the clearinghouse policy do not really directly affect or concern retail trader like you and me. Another one, I will talk about some clearing and settlement processes that you need to understand and know. And lastly, of course, this concerns you directly because your P&L will be moved in and moved out from your account in the form of technically valuation margins. Yeah. So we'll have some case study on that. And finally, I will show you some places, resources for more futures information if you want to learn more. So this is the session 1. So basically, Bursa Malaysia Derivatives Clearinghouse is owned by Bursa Malaysia Derivatives Berhad. Yeah. So this clearinghouse owned by the Derivatives Berhad. Basically, the function of a clearinghouse is to eliminate credit risk between clearing participant and among clearing participants. Technically, there's been clearinghouse stand in between. I will show you more diagrams to make you understand more clearly. And when the trade is matched, this clearinghouse becomes the CCP, Central Counterparty. That means eventually, after any trade is matched, the buyer buy from the clearinghouse and the seller sell to the clearinghouse. That means the participants in the market do not trade directly from participant A to participant B. Eventually, all participants only have one counterparty, which is the clearinghouse. And each buyer or seller have obligation only to the clearinghouse and not to others parties. So this is the functions and the role of a clearinghouse. Of course, you will ask what is the significance. After we show you why there is a need of a clearinghouse, what is so important to have a central counterparties. This is one of the most important role of the clearinghouse. Clearinghouse guarantee performance of contract traded in Bursa Malaysia Derivatives. That means you don't have to worry about who is your counterparty, whether the counterparty have good credit standing or not. Because eventually all participants will only have relationship with the broker directly, but indirectly is the clearinghouse. And of course, once they become the central counterparty and also they guarantee the performance of the contract, they need to have some risk management practice in place to safeguard the financial integrity of the clearinghouse and also the market as a whole. So the objective are enable early detection and unsound market activities. After I will show you some of the things that do to have an early detection of if the market is facing some crisis, especially from the market and credit risk perspective. And also, they will have a risk management policy in order to prevent the accumulation of losses. I will show you one by one after this. And of course, there are some requirements, especially from the financial side, on the clearing participant. That means the brokers. In order to ensure that the brokers and also the clearinghouse has sufficient financial resources to face any financial challenges arising from the trading activities in the market. And of course, when you have all these plus others risk management measure in place, you allow the clearinghouse to take swift actions to safeguard the financial integrity of the market. Because especially a stock market and a derivative market, if there's anything happen to it, it will affect the entire financial market and technically affect the entire operation of the country. Because most of the largest listed company have been listed in the Bursa Malaysia. If anything happened to the clearinghouse and the stock exchange, eventually, definitely it will have a big impact to the entire operation of the countries. So one of the things that they implemented is margining and mark-to-market. What is this margining and mark-to-market? Basically, this risk management function is carried out in the derivative clearing on a daily basis. Every day, they will do mark-to-market and calculate margins. What is this about? It involves the collection of a performance bond. Another name for performance bond is margins. We always said margin, but actually the real name for it is performance bonds. And also they conduct daily mark-to-market and also intra-day margining. Not to worry, we will have a lot of examples to go through this so that you understand what are these all about. Another risk management policy is segregation of client funds. Client, that's been you and me. What is this segregation of client funds? All clearing participants, that's been the broker, the clearing broker that do clearing for your contract, they are required to separate their client position and the funds from their own account. That means this broker, they may have some own account from their own trading operation, and also at the same time, they are also managing your accounts. So with this policy, they are required to separate their client's account and their own accounts into different accounts in the settlement banks. So they have to open two types of settlement account with the settlement banks. What is the segregated? So segregated are those accounts open for you and me, for all the clients. So all clients, they have a account and is put under segregated. That's means each of us will have a house. Another one is unsegregated. That is the house account. Yeah, that's means the broker have one account as an unsegregated account. And this is to protect you and me in the event of any insolvency or financial instability of the clearing participant. That means not like other company, maybe if they have money in their account, when they have any financial difficulty, they can draw on any financial resources put in their company accounts. But this is different. As a clearing participant, they manage two different accounts, and even they've faced with any financial difficulties, they are not able to touch your money or my money because all these are put under segregated accounts. So we are very safe. Anything happen to their financial standing, they will not be able to touch our account. Just like when you trade stock, your money is under a trust account. The broker can never touch the money in the trust account to use for their own purpose. Yeah. So in the derivative world, it's called a segregated account. It's similar to what you have the trust account in your equity broking industry. So we basically cover the risk management policy that impact you and me. Actually, clearinghouse have another easily 5 or 6 risk management policy, but that is more on clearinghouse and also the clearing participant and the broker level, and not so much on our retail trader levels. Yeah. So section 2 is we will talk about clearing and settlements. So before I start, let us go through a few terminology before we move on. One thing is an open position. That's been after you initiate a new buy or new sell of your derivative contract, before you close it, that is called an open position. That's mean before you buy or sell an opposite position, that is called open position. Means that that is an unsettled contract. Outright position means that you buy or sell, long or short. So straightforward. Directional trade, either you buy or short the position. Yeah. Why I bring in outright? Because there is another type, so-called spread position. It's a combination of two contracts, one long, one short, in different contract months of the same product or related product. There are many types of spread position, but in this webinar, we will talk about only 2 types. Yeah. Another concept is spot month contract. Normally, when we talk about spot month contract, we talk about the first contract month of a series of contract months. But like for example, if you are trading in the FCPO, you know that FCPO, the most actively traded contract month is the 3rd contract month. Yeah. So this is the difference. But most of the contract traded in the market, the spot month contract normally refer to the first contract month. And the farm month contract, we refer to those other non-spot month contract. Yeah. This concept we need to understand because of all this one will be used when we do clearing and settlement and do margining calculation later on. So you have to understand these few terminologies. So let us show you what is the difference between when you trade a contract without a clearinghouse. When you trade a contract in the market without a clearinghouse, most likely it's OTC. For example, you go to buy a bond or buy a product over the counter in a bank. Then your counterpart actually is the seller. So it's between you and the banks, you and somebody else, yeah, directly. So this one is the matching or trade without a clearinghouse. What about when you have a clearinghouse stand in between? So when you trade in Bursa Malaysia Derivatives or Bursa Malaysia Berhad on the stock, there's a clearinghouse in between. So when you have a clearinghouse, that means you as a buyer, your counterparty is the clearinghouse. Likewise, if you are the seller, your counterpart also the clearinghouse, and no longer between the seller to the buyer or the buyer to the seller. Yeah. So now you see clearinghouse just stand in between to assume the role of the buyer and the seller with the opposite direction in the market. So from here you can see in the market, initially the buying broker is the buyer of the market contract. This is the buyer broker, so buy from the market. Likewise, the selling broker will be the seller in the market. So once they have their own contract, they will technically deal with the clearinghouse. That means the seller broker, initially the counterpart is in the market, but once it's matched in the clearinghouse, they only deal with the clearinghouse. That means their counterpart is no longer anyone in the market, but instead clearinghouse will stand in between. Yeah. So selling broker is a seller of the open contract, and the clearinghouse is the buyer of the open contract. So you see, selling and buying. So clearinghouse assume the role, replace the participant in the market. So they are the middleman, the middle agent between the seller and the buyer in the market. So when the trade is matched in the system, it will be, the match trade information will be sent to the derivative clearing system. So the clearinghouse operates derivative clearing system to do the clearing and settlement and calculation of the margin. Yeah. So remember, now clearinghouse always stand in between all the buyers and the seller in the market. And because they are the CCP, their central counterparty, and they guarantee the performance of all contract. That means regardless what happened to any buyer of the contract, seller of the contract, and the buying broker, the buying clearing broker, and the selling broker, they guarantee the performance. So they need to have some risk management policy in place and the measure in place in order to safeguard the clearinghouse and also the financial integrity of the market as a whole. So what they do is they do daily mark-to-market and settlements. All open positions are revalued daily against the daily settlement price determined by Bursa Malaysia Derivatives Clearing at the end of each trading days. Meaning to say that every day when they do the clearing and settlement, they will do this daily mark-to-market after the market close. All open position, they will revalue. Revalue, that means whatever price you buy and sell now will mark against the daily end of day settlement price. To calculate what is the P&L, that means to calculate whether your open position is making money or losing money. Then they will do the settlement. Yeah. Don't worry, we will have a lot of examples to show you step by step. And after they do the settlements or the calculation, the resulting gains or loss are posted to each clearing participant account. That means after they do the calculation of each open position, you will have profit and loss. And all this profit and loss will be posted to each clearing participant accounts. That means your agent, your brokers. So we will post to their account. Of course, they will subsequently charge you if you lose money. We will show it step by step. The losses must be paid in cash to the clearinghouse before the start of the trading on the next business day. That means within the day after they post the profit and loss, if there's any losses, they have to top up, make up the difference before the start of the trading on the next business day. And what about gains? Of course, if mark to market, you make money, then actually you can request a withdraw the money from the accounts. Yeah. Besides daily mark to market, you have additional few type of settlements. One is the intraday settlement. When the market is very volatile and the margin erosion reaches certain predefined level, because when you open, before you trade, you will put in initial margin. But if the market is too volatile during the day and the mark to market, the real-time mark to market losses, if really almost reach the level of your initial margin, then the clearinghouse may call for intraday settlements. They will do intraday mark to market of all open positions and calculate the P&L as if this is after the end of the trading day. But this is during the trading period. And the settlement on last trading day, every day you do intraday. Every day you do end of day settlements. And sometimes you do intraday when the market is very volatile. But every now and then, as we end of month, you will always see there's another form of settlement. In a way, is to replace the end of day on this particular day. It's called the settlement on last trading day. It will be done upon the expiry of the contracts. Yeah. And basically, there are two types of settlement: physical delivery for FCPO, FPKO, and also another type is a cash settlement. That means the P&L will be settled via cash. Physical delivery, you actually have to deliver the physical underlying of the contract. If this is FCPO, you have to deliver the crude palm oil, and the FPKO, you have to deliver the palm kernel oil. Yeah, this is called the physical delivery. So you can see from our Bursa Malaysia Derivatives CPO contract. Contract man, you have a spot month and the next 11 months and up to 36 months. And if you talk about final trading day, you can see the final trading and the maturity date. The contract expires at noon on the 15th day of the delivery month. Or if the 15th is not the market day, the preceding business day. Yeah. So now you see, actually each contract will have their own respective, could be different expiry date during the month. Of course, a lot of contract you know that is end of the month. Some are the third week of the month, and this is the 15 days of the month. Yeah, we have to know all this. So on the daily settlement, there are some guidelines. Yeah, maybe you never heard of this. I just want to share with you. Yeah, because you just know, yes, they do daily settlement, but actually I don't know how they do it. Of course, most of the contract, if this is very, very active, which is called the active market, when the contract have a lot of trade recorded near market close for the days, known as active contract. Yeah, when you trade FCPO, you will see most of the time they will trade up to the very last second for the active contract month, like the spot month. But for some other contract, maybe you see there's some contract traded, but may not be up to the very last minute or very last second. So that is the non-active market. That means you see contract traded, but it's not recorded near market close for the day. So this is known as just a traded contract. Yeah, maybe the last contract traded for this contract is like 30 minutes or even 1 hour before market close. Yeah, if the trade stop, you will always see something like this. Most of the very actively traded stock, they will trade all the way up to the last minute. But many others maybe only traded in the morning, afternoons, or 1 hour before close. Those are the non-active market known as the traded contract. And some, just like what you see in stock, in the derivative market is the same thing. Some of the contract are not traded at all during the day. Not at all. Yeah, not at all. So they are non-traded market. In exceptional situation when the above do not apply, additional guideline might be adopted. Actually, there have many settlement methodology, but this is only to show you what are the very basic guidelines to define different type of contract. But actually, they have many ways to determine. So don't worry about, wow, when the market is not traded, how to do settlement. Yeah. Okay, now we talk about intraday settlement. Yeah, and this will trigger intraday margin call. Yeah, could be during days of extreme market volatility. The clearinghouse can activate intraday mark-to-market process during the trading period. What does it do? It involves the revaluation of all open positions, including the new position executed up to that point in time by using the latest price and open position information available. That's mean whatever open position settled yesterday, today market open, there will be some new contract created and also some old contract closed. That means maybe you carry some contract from yesterday, but this morning, before they run the intraday settlements, you already close your position. Then this position will not be recalculated again. But whatever open before the intraday, from the market open, before the intraday monitoring, once they capture into the system, they will be part of the intraday settlement calculation. And the losses have to be paid to the clearinghouse within 1 hour of the intraday margin call being made. Yeah. This is very serious. They will not wait for you after the end of the day. You have to top up your margin. Of course, the clearinghouse will inform the broker, and the broker will inform you. No matter what, the broker have to pay in within 1 hour. Yeah. So what about closing of position? Yeah, end of the day, end of the period, end of the contract. What are the few ways that you can settle your future position? Of course, basically what you normally do is you buy and sell, or you sell and buy. This is the basic one. But in fact, you have at least 3 ways to close your future position if you trade in the futures. One is a physical delivery or the cash settlement. This is talk about the final settlement or upon expiry. Another one is an offset or reversing trade, like what I mentioned a few rounds. After you buy, if you sell the same contract, then you technically already close the position. Or you sell first and then you buy back the same contract, you naturally offset or reverse your trade. So this is the most common way for most people. Another one that is you will hardly heard of, because basically this one is used by maybe funds and also institutions. Normally for retail trader like you and me, we only go for the offset and reversing trade. So closing of position. For physical delivery, you are required to deliver the underlying commodity. Not only on the underlying commodity, you have to deliver to a specific site, yeah, specified by the counterpart on a specific delivery period a day. So the holder of a contract to buy will receive delivery of the cash commodity if he waits until the maturity, and the seller of a contract must make delivery if he waits until the contract maturity. That means after you open a position as a buyer, if you don't offset by selling back to the market before the maturity date and you wait until the contract expired, then you have to, if this is a physically delivered contract, then you have to wait for the physical commodity to be delivered to you. And if you are a seller of this contract and you don't close your short position until the contract expired, you have to deliver the physical commodity to the holder of this contract when the contract expired. Of course, cash settle is very easy. Upon the expiry of this contract, the clearinghouse will calculate the P&L, see whether you make money or lose money. If you make money, of course, your account will be credited with the profit. If you lose money, you will be debited with the amount of losses from your margin account. So very easy. Technically, you don't have to do anything because the clearinghouse and also, of course, the broker will do all these book entries to settle in cash. Of course, offset of reversing trade is whatever you buy in the past, now you just sell. Whatever you sell in the past, you just buy. Technically, this one talk about before the expiry of the contract. So we just briefly look at this physical delivery process just to understand. I doubt any of the retail will want to do this because all these are basically used for hedging purpose. Yeah. So let's go to A. So if you are the seller for a crude palm oil or palm kernel oil, so you hold your short position, you sell the contract, you hold your short position until the maturity. Upon maturity, what you do is you need to deliver your crude palm oil CPO to the pot tank installation, yeah, PTI, pot tank installation. You deliver your oil to them. So what do they do? After you deliver the oil to them, they will conduct an appraisal. That means they will appraise the quality of the oil and also the quantity of the oil to see whether it meets the quantity and quality specification or requirements to fulfill the obligation of this short position in this FCPO of FPKO. That means they are the one to do appraisal whether the oil that you deliver to the pot tank installation meet the quality and also the quantity requirements specified by the clearinghouse. So after they check, okay, good, meet the requirements, they will issue an electronic NSR, negotiable storage receipt. Yeah, that means this NSR is the proof, a document to prove that, yeah, this so and so already sent in, for example, 25 metric ton of the crude palm oil to me as a pot tank installation. And after my assessment, I verify that, yeah, they meet the quality. So they will issue the ENSR and they will put the name and location of the pot tank installation. Currently in Malaysia, we have 3. Port Klang, in Johor and also in Penang, Butterworth. Yeah, we have 3 different locations to deliver the physical crude palm oil or palm kernel oil if you want to do physical settlement. So that we have the name and location of the PTI and the date when they do the appraisal, and of course there is a certification of the quality and the validity date of the ENSR. Because this is a commodity, you cannot put it like for too long. After you put in the pot tank installation for a period of time, the quality may change. Yeah. So in order for them to ensure the quality still meet the requirement laid out by the clearinghouse, they will specify, yes, you put your oil here, and also I check the quality, but based on the requirement, you can only put here maybe so many days. Yeah, because they can only guarantee you the so many days that is still in good quality. Yeah. So they put a validity date of the ENSR. That means if you come and claim your oil after the validity date, they will not be able to guarantee you the quality of the oil. So you are on your own already. Yeah. So of course they have all this. They will send, of course, this one send back to this, and they will send the ENSR to their clearing broker. Yeah, this is by the client. Yeah, so the port 10 installation send back the ENSR to the clearing, and then they send to the clearing broker. And this ENSR must be submitted during the tender period. The tender period for FCPO is from the 1st to the 20th of the month. Yeah. So the clearing broker will submit this ENSR to the clearing house. Yeah, Bursa Malaysia Derivatives Berhad. And the tender advice will be allocated to CP on a proportionate basis. That means, yes, you send me certain number of oil. That means, like for example, 1 unit of the contract or one contract is 25 metric tons. Maybe they submit, they want to surrender or they want to deliver 100 metric tons. That means this equivalent to 4 contracts. Yeah. So-called 4 contracts, who should I send to? Yeah. There are so many brokers, there are so many buyers in the market. Who should I allocate to? So with this 4, they will calculate, okay, this is the 4. And in the total market, for example, if there are 40 open position, when this client tender only 4, that means only 10%. So they will find, okay, now 10%. So maybe what they do is, if you have only clearing broker B1 and B2, they will say, okay, I will allocate up to 10% of your open position. If 10% of the open position for broker B1 is 1 contract and the clearing broker B2 is 3 contracts, then based on this calculation proportionate to their open position, clearing broker B1 will get 1 and the clearing broker B2 will get 3 contracts. So now they allocated these 4 contracts of the FCPO, that's been 100 metric tons, to these 2 clearing brokers. But there's another level. Within each clearing broker, there are so many clients. So who should I give this oil to? Because tender is 20 days, every day we have different quantity. So at the clearing broker level, the clearing house will calculate based on percentage. But at the client level, they will do a random allocation. Yeah, that means they have an algorithm and then randomly assigned to the client. So tender advice allocate to client on a random basis. So now you know, clearing broker basis on the proportionate formula, but client is on a random basis. This is how the clearing house allocate the physical commodity to the buyer of the CPO or PKO if they choose to hold their contract until the physical delivery period. That is on the seller side. So this is on the buyer side. So of course, the buyer very simple. They just make payment. Now, client, they make payment and make payment to the clearing broker. Of course, the clearing broker, whatever payment they receive, they pay to the clearing house. Yeah. Of course, the clearing house, after they receive the payment, they will send them a reference number to the clearing broker. The clearing broker will send them a buyer reference number to the buyer, and the buyer will submit the reference number to the port 10 installation and receive the delivery of the physical underlying of the commodities. So these are the basic process. But as I say, most of the retail trader like you and me, we will not be bothered with this. And if you really trade physical delivery product, make sure you close off all your open position before the physical delivery period. Otherwise, you will have a big problem, because I really heard that in the past, there's one trader forget to close the position and this individual trader receive NSR from the broker and also the clearinghouse, and he's forced to sell the physical product to someone in the market at the maybe much lower price to cut loss, because no one will want 25 as an individual. No one to want to use 25 metric tons of crude palm oil. Yeah, so make sure for physical delivery contract you have to close it way before it. Yeah. So the last one is exchange for related position, and this not only happen for crude palm oil. If you are in many other exchanges or clearinghouse, they have this facility exchange for related position for many others physical delivery instrument or commodity. Yeah. Can be gold, can be treasury bond, and any other commodity that allowed for physical delivery. So basically, it's an arrangement between two parties whereby a futures position is exchanged for a related position or vice versa. Yeah. Let me show you. So basically, two parties, one have the long future, one have the short futures. And also one have the long physical goods and one have the short physical goods. The related position can include cash or physical, swap, OTC, derivative, or other futures position. They have many types. As long as it's agreed between the two, then the clearinghouse can facilitate the exchange for related position. So the related position must involve the commodity or financial asset underlying the future contract. So basically, yes, this is a future contract. When you want to use this to close off your position, the commodity on the underlying asset must be related to the future contract, or must be a derivative or byproduct or related product that has a reasonable degree of price correlation to the commodity or financial asset underlying the future contract. Yeah. For example, if this is a crude palm oil futures, then you can exchange with crude palm oil, or maybe if they say okay, then you can actually exchange with crude palm kernel oil, for example. Or maybe if you have a gold product, maybe the gold is a pure gold, and the gold future may allow you to exchange for a physical gold, which is not a pure gold. Maybe it's a 916 gold, yeah, for example. Yeah. So basically, the session 2 cover clearing and settlement. And this is the last session, and this one concerns you the most, because basically when you trade in the future market, you will basically, most people will only know about this part, which is the margining. We'll bring in some concept and case study, because most people, when they trade derivative and future, what they know about is when I open a derivative account, I will only put in the initial margin. And subsequently, when there's any P&L after the daily settlement, I will put in more money. They may not even know that it's called variation margin. So today, after this session 3, I believe most of you will be much better off than most people in terms of what is a P&L, why there's a P&L, and how do you manage a P&L. Yeah. So basically, the technical terms for margin, initial margin, is a performance bond. It's a form of good faith money deposited by buyers or seller of derivative contract before they are allowed to trade. Yeah. So before you can start trading, you have to put in money into your trading account in the form of initial margin. Yeah. Technically, in the past, there are two levels, initial margin and maintenance margin. But from what I understand currently, most of the broker, if not all, the initial margin and the maintenance margins are the same amount. Yeah? So they only show you one amount. Yeah? But basically, in the real world, they should have two levels, initial margin and maintenance margin. So this is to provide the protection to the clearinghouse to guard against the inability of derivative users to pay losses arising from adverse price movement based on the current and potential. Why protect the clearinghouse? Because when the clearinghouse stand in between as the central clearing counterparty, the CCP, they guarantee the performance of the contract. That means no matter what happened to any parties in the markets, clearinghouse will guarantee that if you are a buyer, I will deliver the contract or the goods to you. If you're the seller of the contract, I will make sure I have money to pay you after you sell your contract and deliver your contract or your physical goods to the clearinghouse. Yeah. And because of this, they assume all counterparty or credit risk or settlement risk, they have to have something to safeguard their and also to strengthen their financial ability. So the first level they do from the market is the performance bond or the initial margin requirements for all account openings. Yeah, this to safeguard the credit risk and our market risk faced by them based on the current and potential futures exposure. Yeah. Level of margin is based on the historical price volatilities, current and anticipated market condition, and other risk factors. So basically, many clearinghouse, I believe the Bursa Malaysia Clearinghouse currently still using value at risk as the risk management methodology. So they will put in some historical price volatility, basically some of the worst case scenario. What is the largest drop, largest volatility in the past, maybe 10 years, 20 years, 30 years. And also the current, maybe the current period for the last few months. And also what do you anticipate market to move in the future and all other risk factors. Maybe you find it very funny. Yeah, historical price, I understand. Current, I understand. How does the clearinghouse anticipate future market? If you are a current trader, you will notice whenever there is a long holiday period, the clearinghouse will always, for example, a long period, Chinese New Year, Hari Raya, or any other period that prolong the normal holiday, maybe from 1 day to 2 or 3 days, then most likely the clearinghouse will do a special calculation of the margin and will require you to put in more money in the form of special margin. So this is the special margin calculation and special margin period. So they will do a calculation and they put in, if this is another 2 days of holidays, then they will add in another 2 days of maybe the volatility and all this. They will recalculate the margin requirements. So then they will inform the clearing participant, and the clearing participant will inform you saying that Bursa Malaysia Derivative Clearings impose a special margin rates during the long holiday period, maybe 1 week ahead, 2 weeks ahead. They will not do it last minute. Yeah, they will give you some time, easily maybe a few days or 1 or 2 weeks, and inform you that this is the new margin. You have to inform your client. So because of this, because of what? When the current initial margin is only covered to protect the clearinghouse for 1 night or 1 day market movement. When they have a prolonged extended holiday period, they have to cover for another day, because when they have 3 or 4 days holiday, you will never know what happened. The current initial margin is not able to, may not be able to withstand the volatility and may pass all the initial margin requirement currently. So they will put in the addition to 1 or 2 days to recalculate and charge you the special margin. But this only happen most of the time during long period. Maybe this year another special day is just during the period of the elections, yeah, in May. So just briefly talk about the types of margin that you pay actually. Of course, we talk about initial margin is the margin that you pay when you open accounts. And the spread margin, after I will talk to you a bit more. Just now we talk about spread is when you have a long or short combination, a long or short position, rather than the outright. Outright is either long or short, but spread margin, you actually holding two different contracts. One is the long, one is the short. Yeah? And also variation margin is when you mark to market, what is the additional amount that you need to put in. Yeah? So let us go through some example. Yeah? Look familiar? These few slides prepared by my good friend Chong Ting Ting. So I use the same thing so that for whoever have attended her talk, you know that this is the same thing. Refresher for you, initial margin. So maybe to you, you may not be aware that actually beside cash, Ringgit Malaysia, you can have other form of collateral to be used as an initial margin. Maybe you have some foreign currency, and maybe you have other form of collateral. Let me show you. This is one of the best things that maybe you learned today, because maybe all this while, you know that you can use Ringgit, but then only after this you realize that, I have other form of asset. Actually, I can make good use of them rather than sitting idly in the bank account or in the broker account. Now, finally, I know that I can make good use of them to help me to reduce my Ringgit requirements. Yeah. One thing is approved currency. Of course, technically, your broker should have informed you that beside Ringgit Malaysia, you can use another like 8 or 9 types currency to satisfy your initial margin requirements. Yeah. Of course, there will have some kind of haircut. Haircut meaning to say that Ringgit, you pay them 100 Ringgit, they give you the value of 100 Ringgit. But if you give them, for example, Singapore dollar, maybe they will not give you 100% of the Singapore dollar value because of Forex movement. Yeah. So they will have to manage the volatility of the foreign exchange. Instead of the broker or the clearing house absorb or faced with all this, they will say, okay, I will mark your foreign currency with a haircut, meaning to say that if the haircut is 20%, you put in $100 Sing dollar, they will give you the value of in Ringgit term, but 80% of the $100 you deposited. That's called a haircut. Yeah. And also approved share listed on Bursa Malaysia Derivatives. Now if you are also a share or stock trader or investor, you may want to consider putting this into the clearing house so that you can freeze up your Ringgit for other trading or for more trading position. Yeah. Basically, top 30, for example, the KLCI component stock, the 30 component stock acceptable, plus some others. So you have to check with your broker. They may change the list of share from times to times. Yeah. So please check with your brokers. And also letter of credit in Ringgit and US dollar issued by approved Malaysian banks. Yeah. But basically this one is not for retail, because basically the amount can be 1 million, 2 million, 3 million. So basically clearing participant, that's been the broker, the clearing broker, they will make good use of letter of credit so that they will not need to fork out cash from the company. They just have to apply for a letter of credit from a bank, and then they will submit this letter of credit as a collateral for the positions in their broking house. Okay, let's go through some exercise for you to understand more about margins. So you see our current FKLI is 4,000 Ringgit per contract. The new contract FM70 is 900 ringgit per contract, and the FCPO is 4,500. And also, initial margin may vary from time to time as prescribed by Bursa Malaysia Clearing House. Yeah. So now let's do some exercise. So we know initial margin, FKLI 4,000, FCPO 4,500. Now assume that you have 50,000 in your trading account. So how many contracts can you buy or sell? 50,000 divided by 4,500. For example, you want to trade in FCPO. That means you can actually enter into 11 new contracts. 11 contracts. Very simple. Now, spread margin. A lot of institution or more savvy investor, or basically a lot of locals, that means those are the professional trader. They like to do spread trading. Yeah, they do a lot of spread trading. So spread trading will have a much lower margin requirements compared to outright, because outright you and the broker and the clearing house face maximum. That's been 100% of the volatility of the contract. But spread margin, because of your spread position, you buy one and long and short on the same contract. That's mean you buy one contract maybe November month and you sell one contract maybe December month. They will have a very large offsetting volatility, because they are talking about the same contract. It's only different by 1 month, and basically most of the time the direction will be the same. That means if you see November month increase in price, very unlikely you'll see December month drop in price significantly different from the November month. So the overall trend should be the same. That means either moving up or moving down. Yeah. That's why they will have an offsetting effect on the risk exposure and also the volatility. So basically, spread occurs when a trader holds a combination of related future positions, and the clearinghouse impose a lower margin requirement on spread, like what I just mentioned. Yeah. Basically, there are two types of spread. Of course, there are many types, but in terms of margin requirements, currently we talk about two types. Intra-commodity calendar spread. In some of the market or even maybe local market, they term it intra-market spread. Yeah, but the real term, the more technical and professional term is intra-commodity calendar spread. We are talking about a spread position with two future positions on the same commodity. That means, like what I said just now, maybe you buy November FKLI contract and then you sell December FKLI contract. So two contract months, but the same underlying future contract. Or the second one is the inter-commodity spread. This is a spread in two distinct but related commodity. Yeah? Can be FM70 futures against FKLI, or FCPOs against FPKO. If eventually our Bursa Malaysia Derivatives roll out maybe silver contract, then maybe between silver contract and the existing gold contract could be another inter-commodity spread. Yeah, another name for it is the inter-market spread. Yeah. Of course, there are many other more exotic spread. Basically, mostly are for option contract. So let us see how to do this intra-commodity calendar spread margins. Basically, it's based on the correlation of price movement between contract months. Yeah. Of course, based on their analysis, based on the historical price movement, they will know exactly, roughly, what is the correlation of the price movement. That means if November contract move 1%, from the cash market, what happened to the December contract? Do they also move 1% or only 0.8% or 1.2%? So over time, they will be able to calculate what is the average correlation of the price movement for a period. So there are two types of spread. That means they also have two types of spread margin for this intra-commodity calendar spread. One is a spot month spread. Remember just now I introduced the terminology. Spot month, that's been normally we talk about the nearest month or the most actively traded contract month. One of the contract month involved is the near or spot month. This will be the spot month spread. That means you buy one, sell one, or sell one, buy one. The first leg must have the spot month. Yeah. Second leg, of course, is the non-spot month. So this is called the spot month spread. If you do a spread, none of the contract month involved is the near or the spot month, then this will be the back month spread. For example, you trade FKLI, you buy January 2019 and sell February 2019. Yeah, you see, January, February next year. There's no November. So this is called the back month spread. Yeah, spot month spread, they have their own margin requirements, and the back month spread, they also have their own margin requirement. It's different. Yeah. Basically, in general only, not necessary, because calculation on spread margin based on the correlation, based on the volatility. But in general, from what I see, back month spread is slightly lower than the spot month spread, because basically spot month spread is a bit more volatile, more actively traded, and the volatility is much higher than the back month. Back month movement may be not as volatile. That's why they charge lower. And also, why back month spread are normally lower than the spot month spread is because of they are next to each other, and because they are very far in advance. When they have the price movement, their price movement is very in sync. That means there are very high correlation for the back months between these two back months, but not between spot month and the far month. Yeah. And of course, some other consideration. So for example, you want to calculate spread margin. If you have spread position of 10 contract and the margin rate is 500, then you pay 5,000. Yeah. Similar to the normal outrights. Okay, we do another exercise to see how calculate variation margin and also go for margin call. Yeah. This is the same as what you attended before, but I just use my way to elaborate. Yeah. This slide also prepared by my good friend Chong Ting Ting. So variation margin. Variation margin, also known as mark-to-market margin, is required when the mark-to-market losses of your future position cause the balance in the trading account fall below the maintenance. You see the maintenance margin. Last time, maintenance margin and the initial margin has different amount. But now, from what I understand, should be all broker, if not most of them, use the same level. That means if 4,005 is the initial margin for FCPO, then they will also keep the 4,005 as a maintenance margin level. But in the past, many years ago, when I started trading FCPO in 1993, maintenance margin and initial margin is always different. So variation margin is a difference between today and previous business day settlement price. Very easy, right? Today's again previous settlement price. Yeah. But there's another scenario. Today's, when you initiate a new contract in the morning, and after today, at the end of the period, they have to do an end of day settlement. So your entry price today compared to the settlement price today, the difference is also the variation margin. Of course, most of us forgotten about this. We always say, oh, yesterday we carry a position and then today's settlement, the difference is a variation. But there are at least two scenarios. Yeah. Of course, when you even talk about intraday, there's also one form of variation margin. So if you make money, if you credit the gains into your margin account, if you lose money, the broker and the clearinghouse will debit from your margin accounts. And they are realized immediately in a way that every day you have the book entry, credit into your account or debit into your account every single day. This is very different from your experience in the stock market, which is T plus 3. Yeah? This is technically T plus 1 tomorrow. Yeah, or today, technically it's today. You have to settle 2 days. Yeah, at the end of the, after they do the end of their calculation before the market opens. So your future broker will inform you to top up variation margin through margin call. So this is another way to say that when they say, okay, your losses cost your margin account cash balance fall below our maintenance margin, you have to top up. If not, tomorrow they have to cut for you. Yeah, have to top up before the market opens. So let's go through this example in case you hold it for a few days. So day one, you buy 10 contract of December 18 FKLI contract at 1,700 index point. And after a few days, you close all your 10 future position at 1720. So you have a gain of 20 points, yeah, 20 index points. So the variation margin calculation formula is how many tick you gain or loss times the number of contracts that you hold times the tick value. Yeah. Okay. Day one, you open position 10 contract at the price of 1700. This is the FKLI level when you buy the 10 contract. And at the end of the day, the daily settlement price is dropped to 1696. That means you lose 4 points. So 10 contract times the 4-point losses and times 50 ringgit per tick value, you are having a mark-to-market loss of 2,000. This is not paper loss as what you experience in your stock holding. This is the real loss that they are going to debit from your account. So immediately, your broker will debit 2,000 ringgit permanently from your account. This is not paper loss. This is a real loss. Of course, this 2,000 will be debited. Day two, of course, after mark to market, the opening price for your position is 1696. You still maintain the 10 contract. And after the end of day, second day, the price recover to 1702. So you still have 10 contract, 1702 settlement price minus the initial price after the first day settlement. That's been you carry position at this price times 50 ringgit per tick value. Now you make 3,000. And this is again not paper gain because the clearinghouse will give money back to the broker will give money back to your account. That means your account will be credited with real cash of 3,000. That means after 2 days, technically, your account will be increased by 1,000 cash. This is not paper gain or loss. This is real gain and real loss. Day 3, 1702 Today the market is very quiet, up down, end of the day settle at the same level. So you still do the settlement mark to market, but there's no gain or loss. So nothing happened. Therefore, you carry your position with 1702 in your accounts, and you still hold net position of 10 contract. And now you decided, I want to take profit from my position. So you sell all 10. So 10 contract. Now the settlement today, either settlement today, technically, if you want to close it, it's not settlement. Assume you want to close it, you sell at 1720. Then your actual gain is 1720 minus 1702 times 50 ringgit per take value. Wow, you make 9,000 ringgit. So this 9,000 ringgit will be credited to your account at the end of the period. So technically the whole exercise, you make 9,000 here, you make a net of 1,000, you make 10,000. Yeah, very easy. You can calculate from this. You can calculate between 1720 against 1700. That means you make 20 tick. 20 tick, yeah. One tick is 50. 20 tick is 1,000. And because you have 10 contract, you have a gain of cumulative gain of 10,000 ringgit. Yeah. Now very easy to know. So what about the variation margin? We go to another simple exercise, and this is the last part of our talk today. So whether you will be called intraday margin or variation margin, it depends on what is the margin requirement and the cash balance. Yeah. So your initial margin is 4,500, and now in your account is 5,000. You buy a contract of one FCPO at 2,200 ringgit. This is an old slide prepared by my good friend Chong Ting Ting. Now you know the current market is below 2,000. I hope you are having all the short position to make you good money. Yeah. If not, you shouldn't have holding your contract at this level. Should have cut loss long time ago. And the market dropped to 2160. So your calculation of P&L is 2160 minus 2200. And because of for this FCPO per tick value is 25 ringgit. So use time 25 ringgit. Now you have an unrealized loss of 1,000. Yeah. So what is the cash balance? Initially you have 5,000. Now you know that you have a loss of 1,000 to market. Now you only have 4,000. So this 4,000 is lower than the initial and also the maintenance margin requirements. Meaning to say that you need to top up your margin. So the broker will give you a margin call to tell you that, look, you have to top up your margin by 500 ringgit in order for me to hold your position. If not, they will need to cut the position because this is the requirements by the business rule. Yeah, they cannot hold it for you. Okay, I'm done with my slide. Just to inform you that Bursa Malaysia Derivatives are still holding a few more workshops, which is more on the physical workshop. That means you need to attend. For example, the first one is in Bursa Malaysia, and this is in Mandarin. It's just this coming Saturday, risk management in future trading. And there are more futures and option workshop for this month and next month. You can use this to register. And in the next slide, I will show you the QR code. So you can take a picture to register. So these are 3-in-1. So basically you can't register. Only for those who register for this trade, they have attended the first 2, there will be another one. And another one is a Mandarin. Same thing, there will have another 2. And option workshop, some are already done. And there are few more. So please register to learn. Yeah, you may not be trading option at the moment, but definitely it will be beneficial for you to learn more, because some of the strategy and some of the market terminology and some others market information is exactly applicable in the futures market. Yeah, this is the QR code. Please take a photo of it or scan it with your QR code scanner so that you can register for subsequent workshop organized by Bursa Malaysia. And also, of course, I will have a Mandarin for the same topic today. I will have a Mandarin session next week, and I will have another final topic to be conducted in English and also Mandarin. So you have to check the email sent by Casey Lau. So 3 key takeaways. We talk about risk management policy, why there's a need of risk management policy. And of course, now we are much better off in terms of clearing and settlement processes. And of course, now we know why we are subject to different kind of margin and roughly what are the consideration criteria used by the clearinghouse to calculate the margin. Yeah. And if you want to look for more information about future trading, you can go to bursamalaysia.com. Yeah, bursamalaysia.com and click register. Of course, you already logged in as a Bursa Marketplace. Sorry, it's bursamarketplace.com. Yeah, you already registered as a user, but maybe you register as a user for some other reason. If not, you can register as a new user, and you can click register and look for this button here. Look for futures. Yeah, you have dashboard, you have portfolio, you have watch list. Yeah, look for futures. Yeah, then you can retrieve a lot of futures information on future from Bursa Marketplace site. Yeah. With that, thank you for your time. And if you want to follow me, you can follow me on Warren Mark Facebook, and also my company website. If you have any information, any question that you want to ask me, any further information, you can always write me an email. So now is the question and answer session.
Yeah, thank you, Warren, for giving us all this very useful information. So I think this session is quite technical. So, but at least we have a basic understanding of what is like going behind the contracts, right? Like you mentioned just now, like for FCPO and FKPO, we will have the actual commodity that you have to deliver it if you hold the contract until maturity. So and then as my understanding from your teaching is does that mean that the cash settlement is like daily, is every day will be calculated?
Yes, technically every day when they mark to market of all the open position, the resulting P&L will be credited and debited to the client account.
Wow.
It's like stock, you can have a paper gain and loss.
Yeah.
The mark to market, that is an actual gain and loss that will be debited or credited to the client account. So you can see the movement in your account.
Wow.
Yeah. So
I've never traded future before, so I'm not sure how the statements look like. So the statement will be like every day will have a line, right? P&L.
Yeah, now it's everything online. So in your account, you will see suddenly your money reduced because of already to the end of their settlement and movement of the margin in your margin account. Yes, you can see just like your bank account, suddenly today you have money go in, suddenly you have money go out. Yeah. Actual account.
Okay.
It will be reflected. Yeah. After they have done the end of day processing.
So for the attendees, if you want to ask any questions to Warren, you can do it right now. Just post it in the Q&A box. So there's one question asking about the slide. Yes, we will give you the slide because when this session ends, right, you are going to get a link will be redirected to a page to submit a survey. So it's a very short survey. You can get it done within just a few minutes. And then there will be a link for you to download the full slides of what you're seeing here today. Any question, you can just type in the Q&A box.
Yeah, especially for those who just joined this round and missed my last one, especially for those trader or investor, you have a big position in your stock, for example. Because my last session talked about hedging. So please revisit the session and see how you can make good use of FKLI or FM70 to do hedging or to do cash extraction of your current portfolio. Because if you only have a direct exposure in the cash market, like for example, buying stock in Bursa Malaysia, and without knowing how to make good use of future contract, FKLI or FM70, I think this is, to me, is an opportunity loss or it's a waste because Bursa Malaysia have so good product offer in the market for you to hedge against your downside risk or allow you to do cash extraction. We should make good use of all this combination between cash and derivative contract so that we can optimize our returns and also minimize our risk exposure. All the global hedge fund, why they call hedge fund? Why they can deliver 10, 20, or even 100% return on their portfolio year in, year out? Because of they use a lot of derivative contract to do hedging and also trading on their portfolio. So if you have been doing trading in cash for quite some time, maybe it's time for you to upgrade your skill to explore what is this futures contract, outright spread, and also cash extraction and other strategies that can definitely optimize your return and also reduce your risk if you use it as a hedging tool.
Yeah, Warren, like for the case when we have position, talking about the margin and also the margin requirement, you give a lot of example, but I'm thinking like in the case where we have a lot of position, let's say I have a few position in a future contract, and then when there is a margin call or intraday margin call and it is quite urgent, right? The broker will call you and but we might not be able to respond within 1 hour, just put in the money so that they don't close our position. So what do you suggest to avoid this kind of a situation?
Yeah, technically they will give you a net position. That means if you have FCPO, FM70, FKLI, or even option, they will give you a net because when they do intraday mark to market, they mark to market every single contract. Yeah, so they will give you a net position. You may not have a margin call because of you have some long, have some short, money from here, lose money from there. Yeah, but in the event they ask you to fork out money to top out and you do not, either you don't have money or you do not have money immediately to top out. The best thing is you choose contract and then close it. That means you either take profit or cut loss on some of the position so that you reduce the overall margin requirements. But in one of my articles, for those who are not aware, I write a weekly article in Nanyang Xiangbao every Thursday. In one of my article, I talk about when the broker call you for margin call, don't take it as the God treat you so nicely, give you a second chance to help you to save your position. You should take it from another angle. You should take it as it God tell you that you should cut your position. So personally, based on my 25 years experience, most people, whenever they receive margin call, if they have money, they will want to top up because they just don't want to cut off. But let me tell you, maybe 80-90% of the times, after you top up your margin, if you don't top up with a lot more money, very soon you will trigger a second margin call, because in the market, most likely there is a trend, be it stock, futures, option, commodity. That means the trend trigger your first level of margin call doesn't mean that after you top up your margin, the trend will reverse or stay. So the trend may continue rally up or maybe crash lower. So the best thing is when you receive a margin call, that is a signal that you have entered or you are holding a wrong position that is against the overall market right now. So the best thing is to just cut it, reduce the position rather than top up your margin to hold your position. Unless you have some reason to do that, then only you should top up. Otherwise, I will strongly advise the best strategy is cut position, take one step back to study the market again. Should you continue to hold the position at this direction, or should you actually either stay out at this moment, re-enter with a opposite position? Yeah, so it's better to take a step back if you receive margin call.
Yeah, very good elaboration here. There's a question regarding the current market situation. She's saying that should we just be defensive and hedge and short? So it says that KLCI seems to be trading in a range-bound channel between resistance and supports. So what's your view on the market right now? Do you think it's just like hedging and shorting at this moment?
Yes, if Zulin have a view that now it's range-bound, actually we have observed this for quite some time already. For example, you see 2 months ago, like it's between 1650, 1750. Of course, now it's maybe 1680 to 1750 range bound. That's why a lot of people doing range trading. Yeah. Technically, yes, when the market don't have any fresh direction, it's always trade within a range. Even for individual stock, even for commodity, it's the same thing. Of course, best thing about future is you can long or short, and if you can identify a range and you believe that you can do range trading, this is the best. Yeah, because basically, if a commodity or any instrument trade within the range is more predictable, and because if you think that is a range, even within the day there is a range. For example, if the range for FCPO is, for example, 30 basis point, yeah. If during the day the price already moved 30 basis point, if you don't have position, the best thing for you to do is not too long, but maybe too short if this is increasing. So range trading is one of the most, I would say, most commonly used strategy for some people. When they observe long enough, they know roughly when there's no new fresh lift in the market, every day FKLI maybe movement is between 5 to 10 basis, 5 to 10 points, and maybe FCPO is like between 30 to 40 points. So range trading is, you can take advantage of this knowledge. Yeah, definitely range trading is good, but hedging is not for trading. Hedging is for you to hedge against your underlying. For example, you are holding stock. Yeah.
Yeah, very good elaboration. So can you give us some heads up on the next session, because we are going to do a Mandarin one based on the same information today. Next week we are going to do one, and then after that you will have another topic, which is like market strategy. So can you give us some heads up what you're going to cover before we end the session?
Yeah, the last session is talk about, let me see. Yeah, the next session, of course, in Chinese for the same topic. And this will be on the 27th. On the 6th and 11th, I will talk about the last topic, which will talk about the market movement, the volatility up and down, and talking about short selling, because a lot of people still do not understand or not familiar with sell first. So I will show you some example to sell first and how to cover back by buying. Yeah, because a lot of people still scared to sell something without anything. Is it something legal, for example, right? And of course, I will cover some strategy. Currently, market is bearish, market is sideways, and I will show you in chart why I think currently is bearish. You guess, you have to base on something, either based on fundamental, economic data, or based on technical chart. I will give you some chart, yeah. And of course, I will show you some signal to the market based on. So these are more technical in nature, yeah. More technical nature. Of course, trading basically is on technical, yeah. But of some fundamental knowledge also helpful, yeah.
Can we get to one more question here? Amin just started trading FCPO. So he said that especially in the last like 5 to 6 p.m. Is very volatile. So for trading FCPO, what kind of strategy would you advise?
Okay, welcome to the derivative market. I mean, if you have started trading 2 weeks, I believe you already realized that the market very often they will open gap up or open gap down when the market open at like 3 p.m. for example. Yeah, right or not? So my personal preference, trading strategy, my preference strategy, I always close my position about 12 p.m. That means noon time. That means I open my position, but by noon I close off everything because I don't want to subject myself for the market open at 3 and big jump 10 points or drop 20 points. I don't want to subject to this. Yeah, I want to have a good lunch, relax my mind. Yeah, then I go in again. Of course, when the overseas market open and you can see the market is very volatile from 5 to 6. Similarly, I use the same thing. Most of the time, I close my position by 5 o'clock. Unless I'm in the money for like easily 10, 20, 30 points, then I might want to let it run, but I will move my trailing stop loss. That means, for example, if I have 30 point gains, yeah, I will move take profit position maybe only 5 points below the 30 point. Meaning to say that I don't mind closing off my position if drop 5 points. That means minimum I want to protect 25 points of my profit rather than I don't do anything and now I have 30 points. I see lah, if it's 40 points or 20 points, then only I cut. No, I don't do that. So I protect my profit. So most of the time when I do intraday, unless you are a position trader, if you are a normal trader, I strongly advise you to close out your position every day on the FCPO especially because of the volatility, always open gap up, gap down. So I always close up at about 12 and in the afternoon about 5 or before 5. I always close my positions because I don't want to subject to a very huge volatility from 5 to 6. Sometimes it can just move 5-6 tick within seconds. Yeah, so I don't want to subject to this. Why should I be subject to all this volatility? Yeah. So once reach my position target, I will just close off at about 12 or at about 5. So I will open 2 positions during the day. Yeah, this is my strategy. Yeah.
Thank you for sharing your strategy.
Yeah.
So once again, this derivatives webinar is an educational initiative brought to you by Bursa Malaysia Derivatives Berhad. So thanks, Warren. We're going to talk to you again in next week in a Mandarin session.
Okay, thank you, Casey. See you again.
See you again. Bye-bye.
Yeah.